On September 15, 2008, the world witnessed one of the most significant events in recent financial history. Lehman Brothers, one of Wall Street's largest investment institutions, declared bankruptcy. The fall of the bank, founded in 1850 and once a symbol of solidity and tradition, catalyzed a financial crisis that spread across global market, dragging entire economies into recession. Below, we explore how Lehman Brothers reached this point, how its collapse exacerbated the 2008 crisis, and what lessons were learned by governments, banks, and investors worldwide. At the start of the 2000s, the United States experienced a prolonged period of economic expansion, accompanied by relatively low interest rates. This environment facilitated access to mortgages and encouraged consumers to buy properties, both to live in and for speculation. The belief that property prices would rise indefinitely fueled a housing bubble. Banks, eager to profit from this wave of financing, created increasingly complex financial products. Mortgages were packaged and turned into tradable securities known as mortgage-backed securities, MBS. Subsequently, collateralized debt obligation, CDOs, were developed, bundling various types of debt, including mortgages of different quality levels, prime and subprime. These products were distributed worldwide, purchased by pension funds, insurers, banks, and investors seeking seemingly safe returns, backed by the ever-growing value of real estate. At the same time, regulatory oversight became more relaxed. Many financial institutions operated with high leverage, taking on significant debt relative to their equity, while relying on the assumption that the value of mortgage-backed assets would continue to rise. This mix of extreme leverage, complex products, and lack of transparency created fertile ground for a systemic collapse at the first sign of trouble in the real estate market. Founded in the mid-19th century, Lehman Brothers was, by the early 2000s, one of the leading U.S. investment banks, actively involved in mergers, acquisitions, and securities underwriting. However, the bank saw the subprime mortgage market as an opportunity to generate even more profit, issuing and securitizing high-risk mortgages in large volumes. Lehman adopted highly leveraged practices. At times, its debt-to-equity ratio exceeded 30-to-1, meaning that any significant devaluation of its assets could render the bank insolvent quickly. These subprime mortgages, granted to borrowers with poor credit histories or without stable income verification, were packaged into securities, CDOs and MBS, that Lehman either sold or kept in its own portfolio. As the housing market heated up, astronomical profits continued to flow, fostering a false sense of security. When interest rates began to rise and property prices showed signs of stagnation or decline, subprime mortgage delinquencies surged. This affected the value of the MBS and CDOs backed by these mortgages, creating a negative ripple effect on the balance sheets of institutions holding them, including Lehman. In 2007, subprime mortgage defaults began to expose the fragility of structured credit instruments. Distrust spread through the market. Holders of these assets, funds, banks, insurers, sought to sell them but found few buyers. The face value of the securities plummeted, forcing billion-dollar losses. By 2008, several major banks reported losses linked to subprime mortgages. Lehman, with one of the largest exposures to residential mortgage assets, saw its balance sheet deteriorate. Even so, its management tried to reassure stakeholders, claiming sufficient liquidity and equity to weather the storm. In March 2008, another New York-based investment bank, Bear Stearns, faced liquidity problems and collapsed, eventually being acquired by J.P. Morgan Chase in an emergency transaction orchestrated by the Federal Reserve. For many analysts, this event demonstrated that the crisis was not isolated. Lehman Brothers, with similar risk indicators, became the next target of speculation. Throughout 2008, Lehman pursued various strategies to raise capital and stave off insolvency. It attempted to sell parts of its business, sought international investors, such as the Korean Development Bank, and considered mergers with rivals. However, negotiations repeatedly failed. With each failed announcement, Lehman's shares plummeted, fueling further market panic. During the weekend of September 13th to 14th, U.S. Treasury and Federal Reserve officials convened Wall Street executives in an attempt to rescue Lehman Brothers, fearing a domino effect in the global banking system if the bank failed. British bank Barclays showed interest in acquiring Lehman, but regulatory hurdles in the UK and the U.S. government's reluctance to provide loan guarantees derailed the deal within the necessary timeframe. With no buyer or government bailout, Lehman Brothers declared bankruptcy on the morning of September 15, 2008. The news shook Wall Street and global stock market. Investors rushed to offload financial stocks, and credit market liquidity all but dried up. Panic quickly spread, intensifying the crisis and pushing other giants, such as AIG and Merrill Lynch, to the brink of insolvency. Lehman's collapse undermined confidence in the entire financial system. Banks feared lending to one another, uncertain about which institutions held toxic assets on their balance sheet. Interbank rates soared, making it harder to roll over short-term debts. Governments around the world were forced to intervene, injecting trillions of dollars into bailout programs or partially nationalizing weakened institutions, such as the Royal Bank of Scotland in the UK. In the following months, the credit crisis extended to the real economy. Businesses cut investments and hiring, and unemployment rose rapidly. The contraction in consumption and lack of credit impacted sectors broadly, from construction to manufacturing and retail. The world faced the worst recession since the Great Depression of 1929. Although the Federal Reserve and the U.S. Treasury rescued other institutions, such as insurer AIG, they allowed Lehman Brothers to fail, believing it would mitigate moral hazard associated with frequent bailout. However, the decision not to rescue Lehman remains widely debated, as the subsequent economic cost of the crisis likely far exceeded what a potential bailout of the bank would have entailed. Starting in 2010, the U.S. enacted the Dodd-Frank Wall Street Reform and Consumer Protection Act, aimed at increasing transparency and stability in the banking system by requiring more equity and reducing leverage among institutions. Systemic oversight councils and new derivative rules were introduced, among other measures. Large banks are now subject to periodic stress tests to assess their resilience to adverse scenarios. Regulators, including the Federal Reserve, closely monitor liquidity and risk profiles. Over time, institutions have strengthened their balance sheet, maintaining higher capital reserves to absorb potential losses. Lehman's collapse ignited debates about institutions being too big to fail. Although the bank's bankruptcy demonstrated that no institution was exempt from failure, the subsequent rescue of other companies highlighted that governments often still feel compelled to prevent the collapse of systemic players to avoid worse crises. The episode revealed that the pursuit of immediate profits and lack of due diligence can lead to devastating consequences. The culture of large executive bonuses, tied to short-term results, was heavily criticized, prompting many firms to rethink their compensation policies to align incentives more sustainably. The downfall of Lehman Brothers in 2008 remains a symbolic landmark of the global financial crisis. Its collapse starkly exposed the vulnerabilities of a highly leveraged and interconnected banking system based on mutual trust and excessive complexity. The bank's bankruptcy, driven by risky bets and inadequate regulation, unleashed waves of panic that swept across markets and economies worldwide. The key lesson involves the necessity of continuous oversight, robust control mechanism, and a corporate culture prioritizing operational sustainability over immediate gain. While the financial system has strengthened in some respects since then, many warn that institutional memory may fade over time, reinforcing the importance of keeping the lessons of 2008 alive to prevent similar tragedies in the future. The story of Lehman Brothers illustrates just how swiftly even century-old institutions can fall when basic principles of prudence are abandoned amid market enthusiasm and overconfidence.